Hello, everybody. So it is time to cover my most contrarian position, the position where most people disagree with me. And I posted about this on Twitter, and it already started people disagreeing with me, and that's okay. That's okay. Opendoor is a right-sized position in my portfolio, and I'm perfectly fine with people disagreeing with me. But I thought this quarter was as good as we could have hoped for. No red flag, steady Eddie, business as usual. We have a financier operating the business. Carrie Wheeler is a finance person, and she's all about making sure profitability comes back and the business survives, and the business is in a good position to boom again once this real estate picks up. And I just want to go through a conference call really quickly. It was a short conference call this time, very short, and not a lot of new topics discussed, but nonetheless a good one. So as a reminder, the mission, what is the vision and the mission of Opendoor? It's to build the most trusted e-commerce platform for residential real estate. And Carrie Wheeler stated that the industry right now, at current prices, is about $1 trillion a year industry. So keep that in mind. The size of industry they're going after is about twice the size of Amazon's worldwide sales. To give you a sense of scale, that's real estate is the one of the top industries in the United States, and trying to disrupt that, the total addressable market is just beyond what most people can wrap their heads around. Real estate is the number one purchase of most people, most consumers, and it's a tremendous market. That's why this valuation to me on Opendoor makes no sense, because they are positioned in my view to disrupt that industry, and even if they make a tiny dent, the valuation should be much higher. Their goal is to bring the full real estate experience online. They want to bring it online. They want to question the status quo, change the status quo of realtors and working with realtors. They want to offer simplicity and confidence to move from a home to another. And I sold a home for Opendoor, and I bought a home with Opendoor. And I thought it was the most amazing experience, so much better than using the traditional real estate process, that after I've used Opendoor, I told myself never ever again will I ever go for a realtor. And I think I'm not the only one thinking that out of the people who have transacted with Opendoor. They have unique pricing and operations, unique algorithms, and that those operations, this algorithm, this pricing algorithm, will help them become the largest buyer and seller of homes around the country. So think about the disruption. Think about what they're going after, right? It's much bigger than a home flipper or a big real estate agency. They are a tech company. They're going for a monopoly-like placement in the marketplace. Carrie Wheeler stated the real market is showing some sign of stabilization. Much of that stabilization in pricing, right, is coming from home sellers staying on the sidelines and not listing their homes. Few people are rushing to sell their homes right now. All right, they're operating with caution and discipline. We're used to that since Carrie Wheeler came as the CEO. It's less innovation all over the place, just pure discipline. I believe she's the right CEO for this macro environment. They're focusing on low-cost partnership channels to attract more sellers and to buy more homes. They're trying their best to reach more customers in a cost-effective way. One of the ways they do that is by being featured on free third-party platforms such as Zillow, Redfin, and Realtor. But that's not the only way they do that. Another way they do that is they partner with home builders, such that whenever someone wants to build a new home and they already have a home for sale, Opendoor can make an offer. They also partner with sellers agents whose customers sometimes can't sell the homes or have trouble selling the home. The traditional way, seller's agent can come in and offer an Opendoor offer, and there is a reward program to push seller's agent to present an Opendoor offer. So they're going after making offers in a very cost-effective way. Moving on, they are still implementing, testing, starting their exclusives offering. And actually in Plano, Texas is one of their test markets. They only have a few test markets, but in the test markets, when they have Opendoor exclusive, they find that 60% of sellers agree to enroll with exclusive or list with exclusive, and they're creating this kind of induced demand for home sellers, this new induced type of customer, which is a semi-serious home seller, someone who doesn't really want to sell, but if the price is right, they will sell. And you may remember Zillow a while back. Zillow pioneered that with the whole "make me move" price. I don't know if you remember that, but they're going after sellers like that, and I think it's an interesting thing. But this is obviously exclusive is the future, right? The market is giving no credit to Opendoor for exclusives. They have been working on their acquisition criteria. Right? Much of the criticism was that in Q2 of 2022, they overpaid for homes. That was a lot of the criticism and the reason why the stock dropped. So they're acting on this. Now they have a better assessment of home condition, better home assessment platform. They're getting feedback from multiple sources and various parties and databases on their homes that they buy. They have expanded their repair capabilities, and they now enter the tiny renovation market where they make small renovations, which was something that Opendoor didn't used to do. Opendoor just used to do repairs. Now they do a little bit of innovations. They have 2,500 of their longest held homes that were renovated for sale. Part of the hard time they've had selling that Q2 2023 cohort, but they are fixing this issue. 92% of the Q2 cohort is now for sale or is now under contract or sold. So that's tremendous. Their goal is to deliver another 100 basis points, so another 1% of contribution margin next year, thanks to all of their new initiatives, in addition to the 4 to 6% target that they have for their contribution margin on their homes. The layoffs is also part of reducing those costs. They've laid off 22% of their staff at 560 employees. Much of these layoffs were actually in the home purchasing role, in the transactions role, right? And they expect these layoffs to yield about 50 million in expenses saved each year. So again, a financier is at the head of the business. Now let's move on to the CEO. So the CFO is laser focused on selling or telling us that they sold the old book of homes, 3.1 billion of revenues that they sold. It's above guidance. 92% of his Q2 core homes have been sold or are under contract. In Q1, they are purchasing way fewer homes. They only purchased 1,747 homes in Q1, down 81% compared to Q1 2022. You can see this company is going into hibernation mode. They're waiting for the market to stabilize before they jump back in and go heavy. And the reason why there's fewer acquisitions, of course, is there's very few sellers right now, which paradoxically is the reason why the market is stabilizing. Very few sellers are selling because they don't want to lose that mortgage at like 2.75%, and they don't want to exchange that for a 6% mortgage. So very few people are selling, which is keeping home prices high. The fewer sellers have been accepting their offers. Actually, only 15% of their sellers accept their offers, and that because they are quote unquote lowballing people, or I don't like to use this word, but they're really offering the delta between their prior offer and their new offer is actually more than 10% less than what they used to offer back in 2022. So they're making low offers, and they're only taking the sellers that accept to sell for significantly less than market. That's all they're accepting right now. And they're also pulling back on marketing, and that's why they're acquiring less. They're saving money. They're in hibernation mode. Of course, the contribution margin, because of a Q2 cohort and the money they're still losing on Q2 was minus 7.7%, but that's almost going to be done because they're 92% done with Q2. So the new book of homes that they've purchased recently at much better prices, they have a contribution margin of plus 8.5%. So they're taking that loss, right? That adjusted EBITDA loss of 341 million is the remainder of these losses that they had from a little bit of Q1 2022, but especially Q2 2022. They're finishing taking those losses and moving on. Adjusted operating expenses were about 100 million for Q1 2023, and that's significantly reduced, of course, from Q2 2022, where they were 204 million. So they've cut their operating expenses in half. The balance sheet is sound. $1.3 billion of cash plus 459 million of equity in homes. That's their balance sheet. That's like stunning. And they also have, of course, some debt, which means, and much of that debt, by the way, the debt facility is not used. That facility is just there, but it is not used, which means that once the market booms, if if the rates get cut, which I believe they will get cut, the Fed will cut rates with the banking crisis. That's something that's very likely to happen. If you look at the Fed Watch tool, the rates can't stay this high for this long. That's part of the thesis of the channel, right? I call the channel beat the denominator because I don't believe the rates are going to stay this high. Imagine that they have access to so much debt, they will be able to purchase homes faster with better spreads than anyone once this real estate market booms again. And it will boom because homes are rare and homes are hard to build and they're real assets. And people are acutely aware of the need to own their single family houses. Anyways, they've done that. The CFO is really astute and an astute manager. I love this what they've done here. I love it. They've spent $101 million to repurchase $189 million of outstanding notes of outstanding debt. And I say this is stunning because they've essentially made 88 million bucks by repurchasing some debt because the debt is trading at depressed valuations. We've seen a few companies do that, and this is one of these examples where the company can actually benefit from the market thinking they're going bankrupt, and that was good for them to be able to buy back that debt. Again, they mention once again, we're cautious going ahead, we're cautious. Their guidance is, once again, they've said cautious. Remember, they've beat the guidance this quarter. Next quarter, maybe they'll beat it again, but they're saying they're cautious. Let's call it 1.8 billion of revenue is what they expect in Q2. And of course, the loss from Q2 2022 should still be somewhat reflected in Q2 of 2023. They're still unloading these homes, and that's 180 to 200 million adjusted EBITDA loss. But let's keep in mind that that will be the last quarter of negative contribution margin. They did say that in Q3 they still expected some adjusted EBITDA loss, but after that it will go back up. Obviously, as they move away from losing money on this horrible acquisition cohort that they had. So again, the Q&A, they've noted that, I noted again, there was going to be a step up in EBITDA from improved margin. We're really hoping that the EBITDA margin may be positive in Q3. We'll see. As you know, this is not the kind of thing that worries me too much. This is a long-term hold for me. I'm more interested is the company gonna go bankrupt or not? And I definitely don't think they are. Otherwise, I wouldn't be invested in it. They're actually earning interest income on their excess cash on the balance sheet, which I thought was very interesting. Right, that's something major companies with a lot of cash are doing. Like Tesla's doing the same thing. They're earning a bunch of cash, just leaving the cash on the balance sheet. So they're doing that too. They're targeting now 1,000 acquisition per month going forward. No more. They're very picky on their spreads, and that's as long as the market goes back up and stabilizes. They're still going to acquire very few homes. Be super picky. Yeah, they'll buy more. They want to see the mortgage rate stabilize and they actually expect a slight increase in prices towards the end of the year. Going forward, they expect only 90 million of operating expenses per quarter. So again, even more reduced from what we see right now at 100 billion. And their kind of number, their kind of 2024 target, kind of a break even target for them is the $10 billion in sales. And they estimate that to achieve that, they may need to increase just a little bit of marketing. So that would make OPEX go up a little bit. But they're hopeful that they don't really have to because of the low customer acquisition cost channels that they have now with Zillow, with Realtor.com and all these platforms. They're hoping that they aren't going to have to spend too much on marketing. And again, there was one analyst question about exclusives. Exclusives is showing early signs of progress. It's actually refreshing to see analysts looking at the future and looking at their future product offerings. I find exclusive. I made video on exclusives, and I find exclusive to be a wonderful product. But they've just said a few positive words about exclusives. They've concluded with a few positive words about their trade-in offer. It's a program that they have had for 6 years actually, where if you walk in the office of a new home builder, they will be able to get you an offer through Opendoor on your existing home, kind of a trade-in offer for homes, just like you would have in the car market. And Carrie Wheeler ended the call saying that they're focused on innovation, they're focused on market leadership, and they're building a company for the long run. And that's what I believe they are doing too. They are looking beyond this temporary crisis and really preparing themselves to be a lean company. They're really minimizing their expenses right now. They have so much cash on the balance sheet. The $90 million in operating expenses says that they are forwarding per quarter, by the way, per quarter. That's not going to make a major dent. Of course, that's more than 10 years of runway for them. And of course, if you have a bullish thesis on real estate, which I do because monetary printing is what it is. You have to realize that this is a company that's going to be able to swoop in and acquire so many homes quickly because of that facility, because of the infrastructure that they have built. Look at the market in the US where they operate in. They operate in very desirable market in the US. This company has infrastructure. This company has technology. It has a system. It has a very popular app, a very popular website. It is well connected with contractors, with realtors. Um, I like the words to describe this company. This is one of the companies that I really really love, and it seems that a lot of people who love the other stocks that I follow on the channel, they don't like it, and that's okay. That's entirely okay. That's entirely okay. If one doesn't like this company, this is what I consider one of my tier three stocks. It's definitely a riskier stock. Didn't used to be that risky. When I first started buying the stock, I didn't consider it that risky. Now it's part of a riskier bucket, which means that obviously, my exposure is much smaller than what it used to be. But anyways, to me, this was a positive Q1. I'm very happy about the quarter. Can't wait for Q2, even though I have a feeling it's going to be more of the same. And really, this stock is a long-term hold in my view, and I am not selling it anytime soon. And that's it for this video. Not investment advice, just entertainment. I appreciate all of your likes, and I appreciate all of your subscribes. It takes me a while to do this video, so I appreciate all of the support. And thank you for all of your kind comments in the comment section. Thank you. Have a great day.